Silver Rockets was not born small. It was built on ambition, speed, and bold promises. People believed in it. Investors chased it. The market applauded it. But here is the first hook you must remember. Growth without discipline is not success. It is a ticking time bomb. Silver Rockets expanded faster than its foundation could handle. Risk was ignored, warning signs were silenced, and arrogance replaced accountability. In economics, history is clear. Markets forgive mistakes, but they never forgive arrogance. Now listen carefully. Institutions don't collapse in one day. They collapse silently over time. Behind the shining headlines were weak risk controls, excessive leverage, and decisions driven by ego rather than data. When global pressure increased and liquidity dried up, Silver Rockets had no shield. One shock turned into panic, panic turned into withdrawal, and withdrawals turned into destruction. This is the brutal truth of finance. Confidence is the currency, and once it's gone, nothing can save you. But this is not just the failure of one institution. This is a warning to governments, investors, and young entrepreneurs. If you build on hype, you will fall with noise. If you build on fundamentals, you survive the storm. Silver Rockets teaches us that transparency is not optional, ethics are not negotiable, and risk management is not boring, it is survival. Remember this hook: the market rewards patience, but it punishes shortcuts without mercy. Excessive leverage has long been one of the most dangerous forces in financial history, and the collapse of Silver Rockets is a modern reminder of how quickly borrowed strength can turn into structural weakness. Leverage creates the illusion of power by allowing institutions to control large volumes of assets with relatively small amounts of their own capital. In favorable market conditions, this strategy amplifies returns and attracts investors, regulators, and media attention. But here is the critical hook. What multiplies profits in good times multiplies losses even faster in bad times. Silver Rockets built its expansion on debt-driven growth, assuming that market stability would last longer than reality allowed. As leverage increased, the margin for error disappeared. Even minor fluctuations in asset prices began to threaten the institution's balance sheet. When assets are funded primarily through short-term borrowing, survival depends on constant market confidence and uninterrupted access to liquidity. The moment that confidence weakens, leverage stops being a tool and becomes a trap. Silver Rockets discovered this too late. Rising interest rates, tightening credit conditions, and declining asset values exposed how thin its capital buffer truly was. This is the brutal hook of modern finance. High leverage does not create resilience, it destroys flexibility. The real danger of excessive leverage lies in its speed. Losses compound rapidly, forcing institutions into reactive decision-making. To cover obligations, assets are sold under pressure, often at discounted prices, further damaging valuation and credibility. This downward spiral feeds on itself. What began as a manageable financial imbalance turned into a liquidity emergency, not because Silver Rockets lacked assets, but because those assets could not be converted into cash without severe losses. In economics, leverage turns time into an enemy. When debt obligations mature faster than assets can perform, collapse becomes a mathematical certainty. Perhaps the most deceptive aspect of leverage is how it masks risk during periods of growth. Strong revenue figures and expanding balance sheets hide the fragility underneath. Silver Rockets appeared dominant, innovative, and unstoppable. Yet its foundation depended on continuous borrowing. This leads to one of the most important hooks for any economist or investor to remember: leverage delays failure, but it also guarantees its intensity. When correction finally arrives, it arrives without mercy. In the end, excessive leverage did not merely weaken Silver Rockets, it defined its downfall. The institution was not destroyed by a single decision, but by a financial structure that prioritized scale over sustainability. Economics teaches us that stability is built on capital, not confidence alone. And when leverage replaces discipline, collapse is not a possibility, it is an outcome waiting for its moment. Failure of risk management is never loud at the beginning. It operates quietly, comfortably hidden behind growth, profits, and confidence. Silver Rockets did not collapse because risk suddenly appeared, but because it was consistently underestimated, poorly measured, and often ignored. Risk management exists to ask uncomfortable questions, to slow decisions, and to challenge ambition. The first hook is this: when risk management is treated as an obstacle, it eventually becomes the judge. At Silver Rockets, risk systems were present in form, but absent in power. As the institution expanded, exposure to volatile assets increased, yet stress testing remained superficial. Scenarios were built around optimism rather than realism. Market downturns were considered temporary, liquidity pressures were assumed to be manageable, and correlations between risks were underestimated. This is where theory met arrogance. In economics, risk is not linear, it clusters, compounds, and accelerates under pressure. Silver Rockets failed to recognize that risks do not arrive one by one, they arrive together. Here lies a critical hook: risk, ignored, does not disappear, it accumulates interest. Internal controls were weakened by decision-making concentrated at the top. Risk officers lacked authority, and warnings were delayed or softened to protect short-term performance. This created a culture where reporting problems was seen as disloyalty rather than responsibility. When governance fails, data loses its voice. The institution continued to price assets inaccurately, underestimate downside exposure, and overestimate its ability to exit positions smoothly. This is the silent danger of weak risk culture. Numbers stop reflecting reality and start reflecting desire. As market conditions tightened, the flaws became visible. Liquidity models assumed stable funding sources, yet contingency planning was insufficient. When funding costs rose and counterparties demanded reassurance, Silver Rockets had none to offer. Risk management is meant to prepare institutions for moments when assumptions break, but those assumptions were never seriously challenged. The result was delayed response, rushed asset sales, and escalating losses. This introduces another hook worth remembering: risk management does not prevent loss, it prevents panic. Perhaps the most damaging failure was the inability to connect strategic decisions with risk consequences. Growth targets were pursued without adjusting capital buffers or liquidity reserves. Risk was treated as a department, not as a mindset. In modern financial systems, this separation is fatal. When risk is not embedded into strategy, strategy becomes speculation. Silver Rockets did not lack intelligence or resources, it lacked discipline. The collapse revealed a fundamental truth of economics: markets do not punish risk-taking, they punish unmanaged risk. Silver Rockets became a case study in how weak risk frameworks transform manageable uncertainty into institutional failure, proving that without strong risk management, even the most powerful financial structures rest on fragile ground. Loss of market confidence is one of the fastest and most unforgiving forces in economics, and Silver Rockets became its latest victim. Financial institutions do not survive on assets alone, they survive on belief. The moment that belief weakens, stability begins to fracture. Confidence is invisible, yet it holds more power than capital itself. Here is the first hook: you can survive losses, but you cannot survive disbelief. Silver Rockets learned this when market perception shifted faster than any balance sheet adjustment could respond. At first, the signals were subtle. Analysts raised cautious questions, counterparties shortened lending terms, and investors demanded clearer disclosures. None of these moves caused immediate damage, but together they marked the beginning of doubt. In financial markets, doubt is contagious. Once uncertainty enters the system, it spreads through news cycles, trading desks, and investor psychology. Silver Rockets underestimated this psychological dimension of economics, assuming fundamentals alone would protect it. This assumption proved fatal because markets react not to facts, but to expectations. Another hook emerges here: perception moves markets long before reality does. As confidence eroded, behavior changed rapidly. Depositors and investors did not wait for official confirmation of trouble. They acted on fear. Withdrawals accelerated, credit lines were reduced, and counterparties demanded higher collateral. This behavior was rational from an individual perspective, but devastating collectively. Economics describes this as a coordination failure, where rational decisions at the micro level produce systemic collapse at the macro level. Silver Rockets was caught in this trap, facing pressure not because it was proven insolvent, but because it was suspected to be weak. This leads to a brutal hook. In finance, suspicion can be as destructive as truth. Communication failures intensified the crisis. Delayed responses, technical language, and inconsistent messaging deepened uncertainty. Markets interpret silence as confirmation of weakness. Rather than restoring confidence, silver rockets allowed narratives to form without control. Once narratives dominate, data loses influence. Confidence does not return through spreadsheets. It returns through clarity and credibility. Without them, fear becomes the dominant currency. This reveals another essential hook. When trust collapses, information arrives too late to matter. The final stage was irreversible. As trust disappeared, access to liquidity vanished. Even healthy assets became unusable because no one was willing to wait. Confidence, once lost, does not decline gradually, it collapses suddenly. Silver rockets faced a classic run dynamic, where the fear of collapse caused the collapse itself. Economics teaches us that confidence is self-reinforcing in both directions. When it rises, institutions grow stronger. When it falls, even giants crumble. The fall of silver rockets proves that financial stability is not only built through capital and regulation, but through credibility. Markets remember broken trust longer than broken numbers, and once confidence is destroyed, recovery becomes not a financial challenge, but a psychological impossibility. Liquidity crises are often misunderstood as simple cash shortages, but in reality, they represent a breakdown in timing, trust, and market function. Silver rockets did not collapse because it lacked assets, but because it could not convert those assets into cash when it mattered most. This distinction is critical in economics. Solvency reflects long-term value, while liquidity determines short-term survival. Here is the first hook. A firm can be rich on paper and still die overnight. Silver rockets became trapped in this exact contradiction. The institution held substantial assets, yet many were long-term, complex, or sensitive to market conditions. Under normal circumstances, these assets generated returns and supported confidence. However, during periods of stress, their marketability declined sharply. Liquidity depends not only on asset quality, but on the willingness of others to transact. When fear enters the system, even good assets lose buyers. Silver rockets underestimated this reality, assuming that markets would remain functional during stress. This reveals a harsh hook. Liquidity exists only when everyone believes it does. As funding conditions tightened, short-term obligations began to dominate decision-making. Depositors demanded withdrawals, lenders reduced exposure, and rollover financing became uncertain. The mismatch between short-term liabilities and long-term assets became impossible to ignore. Economics describes this as maturity mismatch, a structural weakness that remains invisible during stability and devastating during volatility. Silver rockets relied on continuous refinancing, leaving no margin for disruption. Once refinancing slowed, pressure intensified exponentially. The hook here is simple and unforgiving. When cash stops moving, time runs out. Attempts to restore liquidity through asset sales only worsened the situation. Forced selling pushed prices downward, increasing losses and reinforcing negative market sentiment. Each sale sent a signal of distress, accelerating the loss of confidence and further reducing liquidity. This feedback loop is one of the most destructive mechanisms in financial systems. Liquidity crises feed on themselves, transforming temporary stress into permanent damage. Silver rockets was caught in this spiral, unable to slow it down. Another hook emerges clearly as selling to survive can become the act that ensures failure. Central to the crisis was the assumption that liquidity could always be sourced if needed. Contingency planning existed, but it was built on optimistic scenarios rather than severe stress. Backup funding channels proved insufficient, and timing mismatches grew wider. Liquidity management is not about access in normal times, it is about endurance in abnormal ones. Silver rockets failed to plan for the moment, when markets would close rather than assist. This collapse highlights a core economic truth: solvency is meaningless without liquidity. Institutions do not fail when they run out of value, they fail when they run out of time. Silver rockets serves as a reminder that in finance, Survival belongs not to the strongest balance sheet, but to the one that can meet its obligations when fear replaces trust. Regulatory and governance gaps rarely attract attention during periods of rapid growth, yet they often determine how violently an institution falls. Silver rockets operated within a framework where oversight existed, but enforcement was weak and accountability was diluted. Governance structures are meant to slow reckless ambition, not accelerate it. The first hook is unavoidable. When rules exist only on paper, risk operates without limits. At Silver Rockets, compliance became a formality rather than a discipline. Board oversight failed to evolve alongside the institution's complexity. As operations expanded across markets and products, governance structures remained static. Decision-making power became concentrated, reducing independent challenge and critical debate. In economics, effective governance is not about control, but about balance. Silver Rockets lost this balance by prioritizing growth targets over risk transparency. Warning signs were filtered, delayed, or softened before reaching those responsible for oversight. This creates a dangerous hook aboard that hears only good news is already in crisis. Regulatory supervision also struggled to keep pace. Reporting requirements focused on historical data rather than forward-looking risk. Capital and liquidity metrics were met at minimum thresholds, masking structural weaknesses beneath regulatory compliance. Silver Rockets learned how to operate within the letter of regulation while violating its spirit. This highlights a critical economic reality. Regulation sets boundaries, but governance decides behavior. Without strong internal discipline, external rules become ineffective. Incentive structures further weakened governance. Executive compensation was tied heavily to short-term performance, encouraging aggressive expansion and risk-taking. Long-term stability received less attention than quarterly results. When incentives reward speed over sustainability, outcomes become predictable. Risk management voices were marginalized because they threatened momentum. The hook here is sharp. People do what they are paid to do, not what they are told to do. At Silver Rockets, incentives quietly shaped decisions that governance failed to challenge. Transparency was another casualty of weak oversight. Complex financial structures and limited disclosure reduced clarity for investors and regulators alike. Information asymmetry increased, allowing vulnerabilities to grow unnoticed. In economics, transparency is a stabilizer, opacity is an amplifier of crisis. Silver Rockets underestimated how quickly uncertainty grows when information is incomplete or unclear. Once stress emerged, the absence of transparent communication accelerated distrust. The failure of governance was not a single mistake, but a pattern of neglect. Oversight bodies assumed systems were stronger than they were. Regulators trusted internal controls that lacked authority, and leadership underestimated the consequences of unchecked power. Economics teaches us that markets can tolerate risk, but institutions cannot survive the absence of accountability. Silver Rockets collapsed not because regulation failed entirely, but because governance failed where regulation could not reach. The systemic economic impact of a major financial institution's collapse extends far beyond its own balance sheet, and Silver Rockets demonstrated how quickly localized failure can become widespread instability. Financial systems are deeply interconnected, bound together by credit relationships, shared confidence, and synchronized expectations. When one large institution falls, the shock does not stop at its doors. Here is the first hook in modern economics. No major failure is ever isolated. Silver Rockets' collapse sent ripples through markets that had no direct exposure, proving how fragile interconnected stability can be. As news of the collapse spread, market volatility increased sharply. Investors reassessed risk across the entire sector, not distinguishing between strong and weak institutions. Asset prices declined, funding costs rose, and liquidity tightened system-wide. This reaction was not driven by fundamentals alone, but by fear of the unknown. Economics teaches that uncertainty is more damaging than bad news because it forces markets to assume the worst. Silver Rockets became a reference point for vulnerability, triggering defensive behavior across the financial system. The hook here is powerful. Markets don't wait for evidence, they move on instinct. The spillover effects extended into credit markets. Banks and lenders became cautious, reducing lending not only to financial institutions, but also to businesses and households. This contraction slowed investment, weakened consumer confidence, and threatened economic growth. What began as a financial collapse evolved into a macroeconomic concern. Silver rockets did not just fail as a company, it disrupted the flow of capital that economies depend on. This exposes a critical hook. When finance freezes, the real economy feels it next. Government and regulatory responses added another layer of complexity. Emergency measures were considered to stabilize markets and prevent contagion. While such interventions can restore short-term confidence, they also raise concerns about moral hazard and long-term discipline. The expectation of rescue can distort incentives, encouraging future risk-taking. Silver rockets collapse forced policymakers into difficult trade-offs between stability and accountability. This reveals a recurring hook in economic history. Every bailout solves today's crisis and plants tomorrow's question. Public trust in financial institutions also suffered. Ordinary investors and depositors became more skeptical, questioning the safety of systems once considered secure. This erosion of trust affects savings behavior, investment decisions, and long-term participation in financial markets. Confidence, once shaken, takes years to rebuild. Silver rockets accelerated this erosion by reinforcing the belief that large institutions are not immune to failure. The broader lesson is clear and unsettling. Systemic impact is not about size alone, but about connectivity. Silver rockets fell, but its shadow stretched across markets, institutions, and economies. Economics reminds us that stability is collective, vulnerability is shared, and when one pillar breaks, the entire structure feels the strain. So let me end with this powerful truth. Destruction in economics is not the end. It is a lesson written in bold letters. Silver rockets fell so others could learn. If you are an investor, question the shine. If you are a leader, respect the risk. If you are a dreamer, build with discipline. Because in the world of economics, those who ignore reality get destroyed, but those who respect it rise stronger than ever. Thank you.